So we hit peak industrial production in 2008, and almost nowhere has it gone higher. The US industrial production has been sideways ever since. And many nations, particularly in Europe, it's actually gone down. Germany's down, the UK's down, Spain is down, Italy's down. These are really bad things. So our productivity has declined. Our trend rate of growth has declined. Asset prices keep rising, but they're unaffordable for all of us. All the central banks agreed pretty much around the same period of time to start printing money, debasing all of fiat currency. Asset prices ripped. If asset prices ripped, well, guess what? The collateral of the system is now saved. So they save the system via this particular mechanism. Now, these are optics. They're not reality. They're optics. And I've spoken before, if you divide any of the assets since 2008 by the Fed balance sheet or global total liquidity or any one of these measures, they've gone nowhere. That whole fiat currency debt-driven bubble regime died in 2008. And GDP globally fell. The trend rate of GDP growth ratcheted lower and never rose. But you see, more things happened after 2008 that people aren't really aware of. For example, the dollar has been rising since then. Why? Because the dollar is the global reserve currency. Most of the global debts are in dollars, and there's a shortage of global dollars, and there has been since 2008, and really exacerbated by the time we got to the European financial crisis. So there's a shortage of dollars, there's a shortage of global lenders because of Basel III and the agreements with the banking system. So the dollar rises. Okay, fine, we can deal with that, and that's part of Brent Johnson's dollar milkshake theory. But more importantly, when we look at global equity markets in dollar terms, they haven't gone up. See, here's the MSCI world. It basically hasn't gone up since 2008. When we look at, let's say, a country like Spain in Europe, Spain, I was there over that period of time. It was a terrible situation. Spanish stock market in dollars hasn't gone up. Italy, dollars, hasn't gone up. The Euro stocks in dollars hasn't really gone up. The FTSE in dollars hasn't really gone up. MSCI emerging markets haven't gone up. They've gone nowhere since 2008 in dollar terms. And the same with Shanghai. So the Chinese equity market or the Bloomberg commodity market peaked back then. There's only a few markets that have outperformed this. And those are the ones that I've talked about in the past. Those were technology, crypto. You could argue India as well because it's different demographic cycle. But not only did equity markets peak in 2008, but we also peaked in total debts. So really what we've seen is debt market has peaked. The US debt market peaked. In the pandemic, we had that extra spike, but really it peaked a while ago. And I've talked about this before, and I'll come on to this in a bit, is the debt growth now is really just offsetting the interest payments. And it's all around trend rate of GDP growth. So therefore, debt is not growing faster than trend rate of GDP growth, really, because it's the missing trend rate of GDP growth that goes into paying the interest payments, and the interest payments are where the debt growth is. Those are the deficits that we see.
Bitcoin is a global decentralized currency that is beyond the control or guarantee of any country, and recent months in the Bitcoin ecosystem have been marked by a fever pitch of optimism based on the approval of Bitcoin spot ETFs. These ETFs are driving Bitcoin's adoption into the mainstream through the retirement accounts of millions, as well as the portfolio constructions of thousands of financial advisors and institutional investors. The ETFs miss the point though. Bitcoin is not an asset to hold. It is a currency which is to be used. Bitcoin does not have a price, it has an exchange rate, and the future of Bitcoin is not that of an asset sitting in an ETF or buried in one's backyard in a hardware wallet. Currencies are meant to be used for transactions, which is not yet happening on a scale for Bitcoin. Though day-to-day payments like buying coffee are not a great use for Bitcoin, the future is one where there is robust economic activity denominated in Bitcoin. Bitcoin will shine at storing value, setting large payments, conducting financial financial services, and more. At least 57 countries in the world had inflation rates over 10% last year, and the United Kingdom's was more than 9%, and the United States was over 8%. For the residents of countries with a history of inflation, regime, or currency risk, the day-to-day volatility of the exchange rate of Bitcoin to fiat currency may seem a lower danger than the decade-to-decade fiscal and monetary mismanagement of countries all over the world. Bitcoin becomes more volatile than Ethereum as halving approaches. Bitcoin's annualized 30-day historical or realized volatility went up to nearly 60% late last week, surpassing Ethereum's 30-day realized volatility by nearly 10 percentage points. Bitcoin, which is the leading cryptocurrency by market value and trading volumes, is supposed to be relatively steady compared to the other digital assets, protecting a trader's portfolio from wild swings in the broader market. But however, Bitcoin has been more volatile than Ethereum recently. Bitcoin's annualized volatility went up to nearly 60% late last week, and that is the highest spread in at least a year, according to data tracked by Kaiko. Historical volatility indicates the degree of price turbulence observed over a specific period.
So we've now been fucked because asset prices are rising and we can't borrow money to even get into the property market, but they're also becoming unaffordable because our wages never went up. Okay, so those are the two of the key reasons why. Now, what we need to do is figure out, okay, what does this all mean? Now, what I've shown from all of this is that really the governments have just offset the debt growth via the printing of money. And the balance sheet keeps going up. And that is the debasement of currency effect that is so pernicious. You've got to think of debasement of currency as a hidden tax on everybody. So we're all unable to afford any of these things, and they have just monetized all of the differences here. We've all become debt slaves because it's been mutualized to all of us. They could have increased taxes by 15%, but they didn't. They did it this way. Now, that's also made the rich get richer because they can own the asset, and the poor get shut behind. But the other thing that we have hit is peak humans. You see, if GDP growth is driven by population growth, productivity growth, and debt growth, I've just explained that debt growth broke in 2008, not coming back. Population growth also peaked back then too. It started peaking in 2000. And what we've seen is things like the labour force participation rate fall. And this is the bigger story, the demographic story behind which this is all driven. Peak humans have created the problem of lower trend rates of GDP. Peak humans are what we face in our future. So the labour force participation rate in the United States, as the number of people who are active in the labour force, has been declining. So that means there's less productivity because we've got this ageing population. Also, there's less industrial production because less people are in the labour force. It kind of makes sense, right? So it's a problem that is going to continue because when we look at forward-looking elements, the working age population in the US has been falling over time. Most countries in the world are actually shrinking now of the major developed economies. With everybody's major economies all shrinking in population, it means their trend rates of GDP are declining, industrial production is declining. But what I found as part of the everything code was that actually, once you strip out all of the complexity of markets, there is one thing going on. Government debt is just being created to offset the aging population. This chart, I think, is one of the most stunning charts I've ever found. I've never seen it anywhere else. Most of my everything code thesis doesn't appear anywhere else in the world. It's all proprietary research. And this simple chart says a lot. So if you get your heads around that, government debt as a percentage of GDP is basically driven by demographics. So as the population ages, growth slows, government debt increases because they're having to pay the interest on the debt to offset the growth that's missing. It's trying to keep the system together. Now, not only that, but if we put the Fed balance sheet against the same chart, we've got the same thing. So the Fed balance sheet is really a function of population.
Bitcoin Ethereum volatility spread flipped positive weeks after the US Security and Exchange Commission (SEC) green-lighted nearly a dozen spot Bitcoin ETFs, allowing traders to take exposure to the cryptocurrency without owning it. Since then, traders have been squarely focused on the activity in the spot ETFs, with net inflows breeding upside volatility in Bitcoin and the broader crypto market. And in the meanwhile, the dwindling probability of the SEC approving an Ethereum ETF in May seems to have demotivated Ethereum traders. Bitcoin's blockchain upcoming reward halving, which is an event which happens every 4 years that reduces the pace of per block BTC emission by 50%, could be another reason for relatively higher volatility in the cryptocurrency recently. The halving event is coming soon. On April 21st, the inbuilt code will reduce the per block reward paid to miners to 3.125 Bitcoin from 6.25 in half, and halving the miners' revenue, which as by tree is currently at $26 billion annually. Right now, the consensus is that halving is bullish as it halves the pace of the supply expansion, creating a demand-supply imbalance in favor of the price increase. Demand side remains unchanged or even strengthens. Bitcoin chalked out stellar rallies, setting new record highs over 12 to 18 months following the previous halve, which occurred in November 2000, July 2016 and May of 2020. And what's different this time around is that Bitcoin has surpassed the previous bull market peak of around $69,000 weeks ahead of the halving, which makes the upcoming event all the more exciting for traders. The current positioning being so extended is setting the market up for a very interesting sell the news halving cycle play, and should there be a real pullback, we stand to see excessive futures becoming liquidated. Volatility skew to favor the Bitcoin's option trading market has also been pricing the halving event as well. While all of this is going on, meme coin madness is breaking the Bitcoin halving cycle. Crypto industry analysts are calling the current Bitcoin halving cycle the weirdest bull market on record, following a premature Bitcoin all-time high and a massive rush into meme coins. And on April 1st, Chainlink community liaison Zach said that this bull market has been weird in a post to his 170,000 followers on Twitter. Historically, bull runs would see liquidity flow into Bitcoin before moving into Ethereum and other high capitalization coins and finally moving down the chain. But however, the market skipped a couple of steps that we have seen with previous cycles, with flows going from BTC straight to meme coins, which is a bit unusual. This is exactly what he had to say, Zach Rines, and I think most people would agree this bull market has been weird. BTC performance has been clearly supercharged by the ETF launch, injecting liquidity into the space, but liquidity that has flowed directly into meme coins. The market skipped a couple of steps that we have seen in previous cycles. There's been a few alt rotation outliers, but for the most part, the vast majority of alts, even larger ones with solid fundamentals, have been tracking mostly the same. And meme coin total capitalization surged to $70 billion on April 1st, primarily driven by pumps in newly launched tokens such as Solana based meme coins and Book of Meme and older meme coins like Peep. And the Coinbase layer 2 network base has also become a hotbed of meme coin speculation. The recently launched base native token Degen is one example, having skyrocketed around 2,800% over the past month, and this coin has gone up 28 times in the past 1 month. 28x is a lot. $1,000 becomes $28,000. And the meme coin is an unofficial token that was distributed to the community on the decentralized social network. I can say with full confidence that this is by far the weirdest bull market crypto has ever had. And he also added that retail is not here in any meaningful way until the entire market goes up together. Another factor adding to the weirdness of this market cycle is that Bitcoin has reached an all-time high before the halving, and in previous cycles, the Bitcoin all-time high arrived the year after the halving. The asset hit $74,000 on 14th of March, and the Bitcoin halving is just 18 days away now, due on April 20th. Analysts have already predicted that the pre-halving retrace is over, and on April 1st, technical analyst highlighted that Bitcoin has reclaimed a key Fibonacci ratio level seen in the previous cycles, but this time it was before the halving.